The truth is, most investors buy at the wrong time. They buy when markets are euphoric and sell when fear hits. But the people who actually make money, the quiet ones, they understand cycles. They know how every crash eventually becomes an opportunity and every boom eventually becomes a trade. And that's why they love cyclical stocks. Companies like GM, Caterpillar and Boeing, they don't go up all the time. But when the timing is right, they explode. Today we are going to talk about how to spot the timing and how to ride the wave without getting wiped out, and why these boring industrial stocks might outperform tech in next few years. So yeah, this is the part of investing nobody talks about enough. How to use the economy to make money. Okay, let's start simple. Cyclical stocks are companies whose profit rise and falls with the economy. When the economy expands, demand for their product goes up. And when things slow down, demand falls. You will find them in sectors like autos, industrials, airlines, and aerospace, construction and steels, or you can say luxury goods. These stocks don't move randomly. They follow the business cycle. Expansions, peak, contraction, recovery. And if you learn to recognize where we are in that cycle, you can make some of the best trades of your life. The problem is most people invest emotionally. They buy cyclical stock right when the economy is peaking and they sell them right when things are about to recover. Smart investors do the opposite. The business cycle is like the heartbeat of the market and it goes through 4 key phases. Expansion. Growth is strong, demand is rising, and cyclical stocks start heating up. Number 2, peak. Inflation rises, rates goes up, and profits begin to slow. Contraction. Recession fear hits, demand falls, and cyclical stocks crash hard. And recovery. The economy is stabilized, and this is when the biggest opportunity appears. This recovery phase is where wealth is quietly built. While everyone's hiding in cash or defensive assets, cyclical investors are accumulating slowly, carefully, when no one's watching, because they know once the Fed pivots or stimulus begins, these companies bounce back faster than almost any other sector. Number 1, we're going to talk about General now. General Motors is one of those stocks people love to underestimate. Yeah, it's not Tesla, it doesn't trend on Twitter, but it's a masterclass in how cyclical industry move. When the economy is booming, car sales soar, people finance new vehicle and credit flows easily, and GM's profits skyrocket. But when interest rates climb or consumer pull back, those same profits vanish. The key with GM isn't if it will recover, it's when. Right now, GM is sitting in an interesting place. Supply chains are stabilizing post-pandemic. EVs production is scaling and margins are slowly expanding again. It's not flashy, but historically, these periods of pessimism are exactly when long-term investors start building positions. And once the economy flips back into growth, auto sales and credit demand usually rebound together. And that's when GM tends to outperform the S&Ps. By the examples, Caterpillar, we can take it. If GM reflects consumer confidence, Caterpillar reflects infrastructure and industrial activities. When government spend on construction, roads, energy and heavy equipment, Caterpillar is right in the middle of it. And with major US and global infrastructure plans still rolling out, this company could quietly benefit for years. Caterpillar is like the economy's mirror. When it's expanding, Caterpillars shine. During downturn, order flows, inventories build up and investors going to panic. But that's the time when pros are watching it closely, because by the time headline says recession's over, Caterpillar has already moved 30 to 40%. Financially, Caterpillar is the beast. High free cash flow and shareholders returns through dividends and buybacks, and one of the strongest industrial balance sheets in the world. The smart money watches Caterpillar's backlog orders and commodity demands. Those are leading indicators for recovery. And then we have Boeing. This one is quite tricky, but fascinating as well. Boeing is pure cyclical play tied to travel, defense, and aerospace manufacturing. The company had a rough few years. The 737 MAX crisis, pandemic shutdowns, supply chain issues, but structurally, the world still needs aircraft. And here is the thing, airlines demand always come back. People might delay travel for a while, but not forever. As a global GDP expands and air traffic increases, Boeing orders book fills up again. What you are seeing now is the company rebuilding itself through the recovery phase. Exactly what cyclical investors look for. It's a high risk, high reward story, but if Boeing continue stabilizing production and resolving debt, it could quietly become one of the biggest turnaround stories of the decade. The lesson here is simple. Cyclical stocks fall hard but recovered harder. So how to play cyclical stock safely? How do you actually make money from cyclical stock without guessing the bottom? A few rules I live by. Watch macro data, not headline. Look at PMI, Purchasing Manager Index, industrial output, consumer sentiment. These are early signals of economic direction. Focus on quality. Not every cycle stock survives every cycle. Stick to industry leaders, GM, CAT, Boeing. Companies with strong balance sheet. Buying during fear, not greed. When everyone's dumping cyclical stock, that's your entry window. Don't go all in. Scale in gradually, average down through correction instead of trying to nail the bottom. Always have a time horizon. Cyclical plays usually need 12 to 24 months to mature. If you can't wait, they are not for you. So yeah, cyclical stocks aren't glamorous. They don't trend on Reddit and get hyped on Twitter, but they are the quiet engine of the market. If you understand the rhythm of the economy, they can help you multiply wealth when everyone else is panicking. Because investing isn't about prediction, the next boom. It's about positioning yourself before it happens. And the beauty of cyclical investing is that the pattern repeats again and again. GM, Caterpillar, Boeing, they fall, but they recover, they lead. So if you want to build a portfolio that truly moves with the economy, not against it, start studying cycles. And in the next video, we will go deeper into defensive stocks, the ones that protect your portfolio when everything else crashes. If you enjoyed this one, drop a like and hit the subscribe button and share it with someone who needs to learn how to stop reaching to the market and start reading. Thanks for watching and I'll see you in the next video.